Hey guys, welcome back. Hope you all are doing well. In this video, we will continue with ratio analysis. Here we will discuss solvency ratio. Guys, whenever we talk about solvency ratio, it generally represent the long-term viability of a company or a firm. Okay, it basically based on how a company will deal with its long-term debt and the debt to equity ratio or the interest coverage ratio. Are they able to pay interest on long term and not? Okay. Here we have debt ratio, we have equity ratio, we have debt to equity ratio, and interest coverage ratio. So we will go through all these ratios with cases. Okay. So previously we discussed liquidity ratio. I hope you guys watched this video. So where we discuss these particular ratios like net working capital ratio, cash, quick and current ratios, asset S ratio, and we also solve some cases based on these particular ratios. Okay, so now time for solvency ratio. So now the question is, what is solvency of any organization or any firm? So solvency means a long-term viability of an organization. So how any specific organization will deal with its long-term debt or the long-term debt to equity or the amount borrowed by that particular organization, how they'll pay in long term and all. So with the help of solvency ratio, you can calculate these particular things. Okay, so solvency ratio are used for determining the viability of an organization in long term, or in other words, it is used to determine long term viability of an organization. Okay, so basically we are studying the long term debt versus the capital or the shareholders equity in an organization. Okay, we have a number of ratios here as well. So debt to equity ratio, we'll discuss debt ratio, equity ratio, and interest coverage ratio. So we will start with debt to equity ratio. So total debt and divide by shareholders equity. Okay, so first one is debt to equity ratio. So debt to equity ratio is one of the most common debt solvency ratio. It represented at debt divided by equity ratio. So the formula is debt to equity ratio, long term debt divided by shareholders fund, or total debt as liability. Okay, so we already discussed this thing while we study the convention of accountancy or the concept of accountancy. So let's say if you started some XYZ business and you contributed, being a owner, you contributed 5 crore rupees. So that 5 crore rupees or that owner's amount is liability for that particular XYZ company. Okay, so total liability or uh, um, the shareholders equity in that particular fund. So with the help of cases, so it will give you better understanding. Okay, so there is a company. Let's say this company is ABC Limited. So this ABC Limited total liability is 1 lakh rupees, and total equity is rupees or 2 lakh 50,000. Okay, so now you know the formula. So we have total liabilities divided by total equity. So liability is 1 lakh and equity is 2 lakh 50,000. So outcome is 0.40%. So that to equity means basically with the help of solvency ratio you are identifying the long term visibility about any company or the overall viability of a company in long term. Okay, so like when you do the fundamental analysis, so you can use these particular ratios. So this way you can calculate debt to equity ratio. Even you can practice more cases based on like examiner, they can give you cases based on like they can give you multiple entries about liability or multiple entries about equity. You have to just add these liabilities and equities. Then the formula is total liabilities divided by total equity. So you'll your outcome will be debt to equity ratio for that XYZ organization. Okay. Next one we have debt ratio. So here basically you are calculating the long term debt of an organization. So debt ratio is a financial ratio which is used in measuring a company's financial leverage. Okay, so higher the debt ratio, which means the company at risk. Okay, so if like any organization, this is a simple concept. Let's say if you'll have more debt in your portfolio, which means there is a high risk because you have to pay interest, okay, in long term, and the future is uncertain about any business or anything. So that's why if you have debt at higher side, so it will make a negative impact on your organization. Okay, so debt ratio is long term debt divided by capital, or long term debt divided by net asset of an organization. So you can go through this particular case. So total liabilities, current liabilities plus non-current liabilities, okay, short term or long term both. So total liabilities for the given organization is 1,10,000, and total asset, current plus non-current, or the short term plus long term, is 2,45,000. Okay, so you know the formula. Debt ratio is total liabilities divided by total asset. So your outcome is 4.5 0.45 in this particular case. Again, like as I told you when we discussed the liquidity ratios, so the only thing you need to know, that is first one is you need to remember these formulas. Okay, so you can make a chart, and another thing is you need to do more practice. So like the number of question you'll solve, so your accuracy will increase toward these particular question. Okay, sometime examiner they ask straightforward question, so your formula will help you. Sometime they also give the different entries, then you have to pick from those particular entries, then it become quite complex. So if you have a clarity about which comes under liability or which comes under assets, so it become very easy, and it is very easy to identify liability and asset. You can suppose that you are running some organization, and these are the cases for your organization. Okay, next one is proprietary ratio. So proprietor, who is proprietor? Founder, who started that particular business. Okay, let's say you started some XYZ organization, so you are the proprietor of that particular one. And let's say you started that particular business with 5 crore rupees. So 5 crore rupees will be liability on that particular organization. Okay, so like we have business entity concept. So as per that particular concept, capital contributed by owner is liability for the firm. Okay, so proprietor or equity ratio. So the ratio expresses the relationship between proprietor funds, the fund of all the shareholders, and the capital employed, or the net asset of any organization. Okay, so equity ratio, again very simple one: shareholders fund divided by capital, or shareholders fund divided by total asset of the firm. Okay, so let's say the shareholders equity is 50 crore rupees, and total asset is let's say 100 crore rupees. Okay, so 100 crore rupees, so your outcome is 0.50. So 0.50 is the proprietor ratio or equity ratio in that particular organization. Okay, so this is the proprietor ratio or equity ratio for this XYZ organization. So again, very simple one. So how they'll make this particular complex? They'll give you multiple shareholders. They'll give you the assets, different assets of that particular one. So you have to sum all these. Then you have to identify total shareholder and total asset of that particular firm, and you can calculate that equity ratio. Okay, so equity ratio or proprietor ratio is shareholders equity, so which is 50 crore in our case, and total assets, which is accumulated asset, are 100 crore rupees. So your ratio is 0.50. Next one, final one under solvency ratio, interest coverage ratio. So interest coverage ratio is used to determine whether a company is able to pay interest on the outstanding debt obligation or not. Okay, so let's say if there is an organization who is raising funds from the market, so if you want, being an investor, if you want to check this company is able to pay out the interest on for these upcoming 10 years or not, so this interest coverage ratio will help you. Okay, how you will calculate? Interest coverage ratio is EBIT, so which is earning before income taxes. Okay, income and other taxes, and divide by interest on long term debt obligation. Okay, so you can go through this case. So here, like, they can give you the exact number, like earning before tax and income, or the interest payment, or even they can give you multiple entries. So there is no use of this one, there is no use of this one, this one, this one, this one. Okay, so you just need to calculate the earning before tax and all, so which is 1,47,000, and the another one is interest. So interest is 9,000. So if you see, earning before tax and income is 1,47,000 divided by 9,000, so which is equal to your 16.33. So this is the interest coverage ratio for the given organization. Okay, so interest coverage ratio is EBIT for a period divided by total interest payment in the given period. So this way you can calculate the viability of an organization to able the pay of interest in long term, okay, or in the given time duration. Okay, so guys, we already did a video on liquidity ratio, which is the most important ratios for examination purpose. Liquidity and solvency, most of time examiner they generally ask question based on liquidity and solvency. So these are very very important one. So you just need to remember the formulas for these ones. So you can make a chart where you study, you can make a chart for liquidity as well as solvency, and you like the number of question you will practice, you will get your proficiency on these particular terms will increase. Okay, so practice lot, practice more and more question based on these ratios. Even I'll after the completion of these ratio series, I'll come with a number of question based on ratio analysis. So I'll come with mixed question, so that will help you to improvise your score in liquidity analysis. Okay, so the only thing till that time I would say ki, just go through these particular ratios, make a chart, make a notes, or try to remember these particular formulas. Okay? So you cannot go for the rectification things, just practice more question based on these particular ratios, so you will be able to answer multiple questions in upcoming time. Okay, so if you like the video, please do share with your friends, and do tell subscribe this channel, so they can also watch these videos. So this is it from my side. Thank you for watching this video. Bye bye, take care all, have a nice day. Thank you.